Let me tell you why St James's Place Polaris 4 fails the balanced pension test. Now, let's take off the velvet gloves. Polaris 4 is marketed as a neat, prepackaged, balanced sounding pension solution. In practice, it's an equity-heavy fund of funds with a brief track record and a fee stack that drags like an anchor. That combination is unhelpful for anyone who needs dependable compounding rather than just expensive marketing. Now, here's why. One, it's far racier than investors think. Polaris 4 is allowed to run at up to 100% equities. Not in itself a problem, but I'll tell you why it's a problem here for you. And by the way, it's allowed to run up to 100% in equities in all market conditions, stay predominantly greater than 80% in shares. It can also allocate to other collective investment schemes, including up to 20% in unregulated vehicles, which add complexity and liquidity risk. That's not middle of the road. That's high beta. That means high volatility with a multi-manager wrapper. I'll explain what all those terms mean. See, if you look at St James's Place's own key investor information, which I have done for Polaris 4, the mandate detail and the risk language in small print show some of these hidden problems. By the way, in case you're wondering what the PN in Polaris 4 means, it's just simply pension version. Okay, so having gone through all of that, here's the second problem. Charges that compound against you. St James's Place itself says that the typical total ongoing charge, advice, product plus fund, so advice plus product plus fund, lands around 1.67% a year for pensions under its unbundled model, which goes live from 26th of August 2025. Initial advice is tiered at 3%, 2%, 1%, capped at 30k. An ongoing advice is 0.8%, with product charges typically 0.35% and fund costs commonly quoted at 0.52%. Okay, lots of numbers to remember. I'm going to break it down what it means in real terms. Even on St James's Place's own numbers, that's meaningfully higher than straightforward passive options. So let's break that down. If you contrast that with a DIY SIP, even if it was 0.37% all in, about 1.3 percentage points a year cheaper than SJP's 1.67% over 10 years on 500k, assuming just a 5% gross return, so something pretty pathetically small, that fee gap alone can mean roughly £92,000 less in your